Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by a global market specialist, Giles Gale and Jan Nevruzi. Okay, another week where I think it was probably most interesting, or certainly there was most on the calendar to look forward to in the US. So let's start there with you, Jan. Let's start with US inflation. That was kind of a very hotly anticipated release this week that everyone was hoping would give some steer, I suppose, to the FOMC's next decision. But in the end, perhaps not all it was cracked up to be. Do you want to kind of take us through what the data told us and what your latest thoughts are there?
Yeah, absolutely. So just to, I guess, summarize it in 3 key points without going too much into the granular details of component by component, but I think on the headline, it was the inflation release was a fairly positive development. To give context, the core inflation number with CPI number, which excludes food and energy, fell down to 0.4% from 0.5%, while the more volatile headline component, which includes food and energy, fell to 0.1% from 0.4% last month. The headline was a little bit lower than expected, but again, I should emphasize that even though there's improvement month to month, those numbers were more or less in line with expectations. Good news, but largely, if you were someone from the Fed who thought that we should be hiking going into the next meeting, you probably didn't change your mind. If you were someone who thought that we should stay put at the next meeting, you probably also didn't change your mind. Nothing too strong to tilt the debate in either direction. Second, we did see an improvement in a very close to watch metric, the shelter component within CPI. So in this case, the rental component, the owner's equivalent rent, so the OER component, they all fell, and they fell in a large fashion. So over the last, call it like 7 to 8 months, those numbers were averaging 0.7, 0.8 respectively, and now they both fell to just under 0.5%. So that's a rather large drop. It's an unusually large change month-on-month basis. And I would suspect that next year in 2024, when we get the annual revisions to the numbers, they will most likely smooth that curve out. So you would see something along the lines of 0.8, 0.7, 0.6, 0.5, rather than like 0.7, 0.8, and then 0.45. That's a pretty big drop. And that being said, the rate of change is probably correct, and it is reflecting what we've already seen in alternative measures, such as the close to watched private market indicators of new rentals, and a lot of companies disclose those numbers, and you can already see that those figures have been falling, and it's a well-known relationship that there is a lag. It's just unclear to most people in this environment how long the lag is, but there is a lag between spot market rents and how long it takes to spill over into inflation. Still good news if the trend continues into kind of like a downward path rather than being a one-off. And finally, even looking past the shelter side, core CPI ex rent of shelter fell to 0.2% from 0.4% last month. That measure, which kind of takes out everything that includes shelter with the CPI and just looks at the more services side of the core services, I should say, ex rent of shelter, fell to 0.2%, and that has been the Fed's preferred way of looking, given the services side driven boost to inflation recently, and the known what I mentioned about like the lags in rent being actually reflected as CPI. So that fell a lot. And then that is still good news. That will translate well, and the drop will translate pretty well into the Fed's preferred measure within PC, which tracks the same exact thing, services X shelter, because the weakness in this month's CPI will spill over due to measurement errors. So I'm talking things like used cars and rents and apparel will move into PC, while other metrics such as airfares and motor vehicle insurance, which were strong, are not going to. And sorry, I said services, but it's just like the core X rent of shelter, not service. In this case, I got them mixed up because we've come up with so many new categories now, and like this then you're looking at like 20% of the overall basket. But if you exclude all of them, inflation is running at 0%. So.
It's like core.
Yeah, exactly. Ultra core, 0%.
That can be our new measure. Okay. So we also had this week the FOMC minutes from the last meeting. Now, obviously, that meeting took place against the backdrop of heightened concerns around financial stability and probably, a bit more uncertainty than we have now around the outlook for financial stability as well. We're kind of 4 weeks or so on from certain events that happened 4 weeks ago. So we have a bit more clarity now. So we always think that the minutes are, I guess, slightly outdated, but they were probably important this time around in terms of determining how the Fed were really considering those financial stability risks and what that might imply for their action. What was your take on those? And then I guess if you could then just kind of round up this discussion with kind of bringing together, inflation, the minutes, and also, of course, because we haven't spoken since NFPs either, they came off the back of a lot of weaker than expected data, but they themselves were slightly stronger than expected. How do you kind of fit all those moving parts together to your Fed view for the upcoming meeting?
Yeah, no, I'll take that from the back and starting with the NFPs. There wasn't really that much in the employment data, similar to inflation, that would have tilted the discussion in either direction. More or less in line. Job growth is there. It's decelerating, but it's cooling down, but it's still at a fairly strong pace. There are some positive for inflation ways to look at the number. We saw average, hourly pay going down. You saw the work week going down, which might imply that there's some increased levels of labor hoarding and drop in output due to overhiring. It's hard to read too much into 1 month's figures, but the trend is in that direction, and wages are coming, I think, closer to levels where we would like to see them. But we will get more information with the ECI that's out later this month, and we will also kind of see what the Atlanta Fed wage tracker also indicates from their side as well. The Fed is certainly close to watching those, and as listeners know, wages are expected to come down if inflation were to come down, unless we see a miraculous boost in productivity, which doesn't appear to be in the cards right now. But maybe the new developments in AI, all the new buzzwords could help in that case. But but just back to the minutes. I'm kind of sidetracking here, but back to the minutes. I'll keep it to the theme of making the 3 key takeaways for us. First, like you said, a lot of the discussion was anchored around the collapse in SVB and Signature Bank, and almost every paragraph starts with the highlighting the uncertainty in the economic outlook now, whether it's about their forecasts, whether it's about the Fed rate path, inflation. Everything was just now specified as having a much wider band of confidence. The risk to the upside were kind of, if they got the baseline wrong, upside could be stronger. If they got the baseline wrong, the downside could be much more pronounced. But they did kind of explicitly mention that there is a mild recession expected later in this year. Of course, the careful Fed watcher could have more or less derived that from their forecasts for their annual growth forecasts and what we've already received. But they did put that in words at these minutes. So a lot of uncertainty around the forecast. Second, we did get a larger breakdown of whether there was a discussion on a pause or no. And yes, there was. They did talk about a pause. Several participants noted that it could be appropriate, but they still voted for 25 basis points. We do know that in times like this, you kind of want to give a unanimous standing. So even if they were at a different view that the Fed shouldn't hike, they might have just went along with the crowd. Similarly, there were some participants who wanted to hike by 50 basis points, but then they dialed down back to 25 because of the banking stress. And finally, on the more micro level, the minutes opened up with a paragraph from the Vice Chair of Supervision, Michael Barr, and a discussion about just generally like the health of the banking sector. The main takeaway there was that the Fed will review what's going on with it, like what more regulations are needed within the banking sector after inspecting what went wrong with the banks who failed. and they will take those lessons and incorporate them into creating more regulation and more oversight measures. So that probably pours some more cold water on the idea that we might get regulatory relief. Last year, discussions such as supplementary leverage ratio reliefs are picking up a lot of momentum. I think that's probably that looks extremely unlikely now, and any associated market impact that could come alongside. So those are the three main takeaways. Pauses were discussed, uncertainty is high, and more regulations.
Let's switch over to Europe then, and let's take it a bit more big picture, I suppose, Giles, because I know that you've been spending some time today digging into the IMF's update to its database, I suppose, given everything that's, it's their half semi-annual conference that they do. Was there anything in there that, stood out to you, you think really matters for us, matters for markets?
Not especially, I'm afraid to say. It was one. Sorry about that. Listen, I mean, that's always the problem with the IMF, isn't it? That they spend a lot of time with the big organization. They spend a lot of time digging into to themes, which in principle, of course, are interesting, but they're not necessarily what we're urgently interested in just at the moment. I mean, a couple of the things that I would just highlight, and then obviously they're reasonably consensus. They usually tend to be honest with you, in terms of their projections. They're a little bit optimistic on the optimistic side, I would say, actually, particularly on growth. But obviously the whole discussion about the downside risk, which broadly we know. I was a little bit interested in I guess again, just because it's all quite consensus. I mean, they seem to be essentially, if you read between the lines, telling us that we should be short euro rates, long euro rates versus US, which is sort of against our view, and we could talk about that a little bit more. There was also a whole chapter on natural rates, which whilst sort of introducing a new sort of framework for looking at that, came up with rather sort of lackluster sort of results, which basically the natural rate in the US is about between 0.5 and 0.75 or something like that, positive, and maybe somewhat negative in Europe. Confusingly, very negative in France. I don't really know what that was about. And the only other thing is, of course, the other area where the IMF is, they're genuinely, they have a real advantage over smaller operations like us, is on debt metrics and debt modeling. And we talked a little bit about France and Sepicor last week. We did some modeling on France as well, actually. We were reasonably positive on Sepicor overall. But it's interesting just to see how the debt to GDP basically crosses over with Iberia. So, well, I mean, Portugal's already through, I guess, but Spain is looking more competitive. And so, I wonder whether there is a bit of a repricing in the pipeline there, Spain versus Semicop.
Okay, a couple of things you said there that I want to pick up on. So let's start with what you started with, which I guess was this kind of cross-market difference between US and Europe. Like you say, you've been, both of us really, I guess, have been of the view that Europe, and I include the UK in that too, European rates should be underperforming versus the US. But the IMF is telling you opposite. How do you feel about that kind of underperformance cross-market now? And
the same. I highlighted the sort of longer-term view, just in the context of the IMF, just because it's there this week. But I don't think there's anything in there that overturns our view that the risks are skewed very heavily in the short term towards US rates outperformance. And of course, that's been doing very well. And I think it's important just to highlight that that's also a view that we really, we've held for quite a while. I mean, maybe we don't talk about it enough, but that was one of our key year ahead themes. So, 6 months old at least. It moved a long way. We actually set that up originally as a sort of long 5 years versus 10-year euro. There's a bit of a curve steepener as well. And I think that's probably still broadly the way I would think about it. Now, I was looking at a few other things. I mean, I wrote a note a couple of weeks ago, for the one just maybe 3 weeks ago now, talking about really the optimization of this trade being potentially at the very long end and at the 3rd-year point. So it's one which kind of evolves, and now looking at it, I think that there's maybe an interesting way to sort of set this up where you might be long US in the wings, because I think that if some of these risks that we're talking about crystallize, then that should be very supportive for the US and the front end. First of all, I can easily see, for example, the front end US trading below Europe and the UK.
Yeah.
And at the same time, one of the things that we were, so it's interesting. The fact 15-year, for example, is much higher in US than in Europe, and so that was really what we were focusing on when we were talking about setting up this in the most optimal way 3 weeks ago. But yeah, still very much with that.
So at the front end, then. We've seen rate hike expectations build back. I suppose there was a bit of catch up earlier this week in Europe and the UK following, NFPs obviously being on a bank holiday for us. And that was a bit of a kicker for a repricing of expectations in the US, which led the rest of fixed income space. How do you feel about, the rate hikes that are being priced in now to the front end of the European curve?
I think it's too much now. And I think that things have changed. Maybe not as much as people feared that they had changed 3 or 4 weeks ago, but they have, I think, very clearly changed. And the risk of significantly higher rates anywhere really has fallen pretty dramatically. Maybe not to zero, but pretty dramatically. And so, for us, it's not a big change. We always thought that maybe 3.5 was possible, maybe 3.25 as a stopping point for the ECB, and we more or less still have that view. And when you push up towards 3.75, that's a level where we had a little bit of push. I mean, when I say pushback, I'm really thinking about Villeroy, who's the kind of key. I guess the bellwether for somebody who can be hawkish or dovish around this range. And just generally, I think that actually whilst we're at a level where I think that there's value in the front end, I think actually the interesting thing is maybe just to try to sell the range. So on the desk, we've been looking at option structures, for example, where you sell reasonably wide range around the terminal pricing at the moment. The other thing we like front end steepness, the inversion of the money market curve has reached the same kind of extreme levels that we've bounced from before, and I think that is again an interesting theme, and it certainly looks more attractive than what I normally talk about, which is just being bearish bunds. It's a similar kind of expression.
Just mixing up. Okay, finally then, you did mention, I said there are a couple of things I wanted to pick up on when you were talking about the IMF, and you also mentioned that you had been updating some of your fair value models recently, I suppose. You've been thinking about frauds and also about asset swaps. Is there anything interesting that you can tell us about any of your updates there?
Well, no, these are all still, to be quite honest with you, it's always work in progress. And so, but I would describe these as absolutely beta kinds of models. But basically, they're both, they're all pointing towards spread contraction. And so that's the key takeaway. Positive EGB spreads, as we so often have, are. And I still think that's the right way to be in France, and frankly probably in Italy as well at the moment, and also in swap spreads. So maybe we can talk about that in more detail at some other point.
Okay, we'll look forward to that.
Right, Imogen, it's over to you now. So there was lots of central bank speak also out of the MBC. What would you highlight for us?
Yeah, quite a bit of speak this week, I suppose. Bailey, well, as governor, was kind of sort of a highlight, although in the end he actually didn't say very much when it comes to monetary policy, which was probably expected if you knew before that the title of his speech was about shifting risk landscapes. So perhaps, unsurprising that it was focused more on the kind of financial stability side of things. And as we knew, and I think I probably said on this podcast last week, the MPC took a fairly relaxed view of the risks to the UK banking system back in the February meeting. And so unsurprisingly, he kind of struck a similar tone yesterday, which markets took a slightly hawkish cue from, or certainly didn't take a dovish cue from, obviously. But I don't think we really learned all that much new in terms of how they're thinking about these financial stability risks. The other headline that I suppose was relevant to markets was just around this idea that they don't really know how much QT they need to do, or how much they need to shrink reserves by, or what kind of end point they're getting to when it comes to QT, quantitative tightening, in their active sales. Again, that's not new. He's previously said, they think they know that reserves should be somewhere between 0 and 900 billion, and they're not really sure where that level, where that, equilibrium level actually sits. So that's the kind of forecast I wish I could get away with, but unfortunately can't. So nothing really all that new from Bailey, which I don't think is altogether surprising. He's one of the more centrist members that is in this kind of data dependent mode. And, the data that we've had so far has really been in line with the MPC's forecast, and the key data, which I'll come on to speak to a bit more about, I suppose, but the key data is really next week, the labour market data and the inflation data. So it's a little bit earlier for him to really assess what, his decision ahead of that. Pill's webinar was much, much more lengthy, but didn't give all that much away either. I think at the margin, he was a bit more hawkish than perhaps the first read of his slides would have suggested. If you looked at his slides, there was lots of charts about kind of turning indicators of wage growth, some of the tightness of the labour market perhaps easing up a little bit. But actually, in his remarks, he commented that although we are seeing turning when it comes to wage inflation and kind of private sector pay growth and those sorts of things, they're not forward-looking indicators aren't suggesting that we will get back to levels that are consistent with, the target level of inflation, or where pre-pandemic we would have considered to be consistent with the target level of inflation. He also talked, about the kind of the lagged pass-through effect of monetary policy via the mortgage rate channel, and how concerned they are about that hitting consumption. And he said that, clearly there's a portion of people that will jump from a very low rate on their mortgage to a significantly higher rate on their mortgage over the next couple of months, ramping up in the second half of this year. But, his assessment was that was still a small proportion of the overall economy. And whilst, the intention is that will have a drag on consumption, that's, partly the transmission mechanism via which monetary policy works and hits the real economy. They don't expect that to kind of be a significant drag on household balance sheets over the next couple of months. So it was difficult to say he was really leaning one way or the other, but I do think a couple of his comments perhaps just leaned a little bit more hawkishly than not. And I suppose the final MPC news this week, let's say, is that they announced Tenrero's replacement. So Tenrero has 2 more meetings left on the committee. She will vote in May and in June, and then she leaves the committee in July. So her replacement will be Megan Green, who is the chief economist at the Kroll Institute and is the kind of has written in the FT. She's got quite an active Twitter feed, so I'm sure that everybody listening to this podcast has already checked out a lot of her recent comments and things she said. But really, from a UK perspective, her commentary has been quite limited of late, and so it's difficult to kind of read across what she says about the US or Europe in terms of what her monetary policy stance will be, given that we're at very different points in the economic cycle. But I think she would be hard pressed to be more dovish than Tenrero, as we've already said on this podcast. So, at the margin gives the MPC a slightly more hawkish tilt, but I think we just have to wait and see her kind of formal commentary to assess just how hawkish or dovish she is going to be.
Okay. Well, so in that case, how does that leave you thinking about May and beyond number C? Well, I know that you basically have this view that the Bank of England is now going to be on hold, but is that strengthened by all of this?
I would say unchanged conviction really around that. Like I say, next week is the key data week, I suppose. We get labour market data, we get inflation. The MPC right now are concerned about the persistence of inflation. And so they've highlighted quite clearly that, the tightness of the labour market and wage inflation is what they're watching very closely to assess that degree of persistence of inflation. So the labour market data from that perspective is going to be very key. But also inflation, given that last month we had quite an upside surprise on relatively broad-based measures, but a lot of the surprise was driven by the more volatile components and some things that may well be argued as a one-off. There was some discussion around it being related to kind of Valentine's Day pricing and the indexing date, which gave the year-on-year number a boost. So we'll be closely watching the inflation data to see how much of a kind of one-off that February print really was. To the extent that really the MPC is data dependent, it's really too early to assess our conviction around that peak ahead of those data prints. But I will say probably, we've long been of the view that bank rate will peak at 4.25%, but recognize that risks are skewed to the upside. And going back to what you were saying, Giles, around how the landscape has shifted, perhaps not as much as we thought 4 or 5 weeks ago, but financial stability risks have risen. And therefore, that upside skew or the risks to the upside have probably lessened a little bit since, we might have spoken just 4 or 5 weeks ago. So we still think that bank rate has peaked. A large driver of that view is that mortgage pass-through channel that I was just talking about with reference to PIL. We do think that that's going to be a significant drag on the consumer, and actually is one of the reasons why we have a slightly more economy bearish view at the end of this year and heading into next year, or certainly don't see a stronger recovery as many seem to see. It's because we do think that this the mortgage channel is going to be a significant headwind, not just for a small number of people, as Hugh Pill puts it, but actually, quite a large proportion. Only a third of consumers are mortgage holders, which is kind of the middle third of the income distribution. But there will be some that are impacted via higher rents as well, being passed on from higher mortgage costs. And those thirds of the income distribution that are going to be most hit by either higher mortgage rates or higher rents are really the sectors of the distribution of wealth that don't have the savings, to offset those headwinds, or those that did have the savings have now spent all of those on higher energy costs. So we do expect that to be a drag on consumption going forwards, and we do think that the MPC can wait to see how that pass-through develops and how that drag to the economy, or how large that drag to the economy really is, before deciding the kind of next step, if you like, on rates. We still are of the view that the next step will be cuts, but we don't think that that's for some time to come. So compared to market pricing, we have a much more dovish view, I would say, in the very near term. The market's looking for something like 22 basis points of hikes at the next meeting as we speak. So, pretty much fully priced really for a 25 pip hike. But then the market has pretty rapid cuts thereafter. So those money market steepness that you were talking about, Giles, I think also look quite attractive in the UK as well, just playing for the market, kind of pricing out or pushing back those cuts after a peak in rates has been reached.
Okay, great. Maybe just as a final question to you, given that there wasn't a lot else to focus on this week, maybe you could just give us a quick update on the supply side and how that is all going at the moment.
Yeah, I think, well, like you say, given the lack of other things, I suppose, on the calendar in the UK, the supply of late has been in focus. And I suppose in focus a little bit because it has been relatively well digested. I think we spoke about this 2 weeks ago when we had 2 auctions where the bid to cover was high and the tail was low. And we saw that again this week in the linker auction and the conventional. And certainly in the linker auction, very strong demand with the post-auction option facility also being taken up, which is unusual for linker auctions. So quite strong demand, which, I guess given that we have long been bearish gilts and long been pushing this view that the supply-demand imbalance is going to weigh on gilt yields, it's a question we've been asked over the last couple of weeks. Are you surprised at how well this supply has been taken down? To which I would probably say not massively. I think obviously we've had a rise in yield, or broadly speaking, we've had a rise in yields, which means, cheaper supply is easier to take down. But also I would just remind people that, we were never of the view that day one of the new fiscal year or even day one of 2023 was going to see a glut of supply. It was never about the heaviness of supply of any one given week. It was much more about the heaviness of supply over the period of time and that, gradually that was going to weigh on yields, and the clearing price for all this supply coupled with the Bank of England's active sales was going to weigh. So I think the DMO will be happy with how supply has gone, but I wouldn't have said it had been overly heavy just yet. And perhaps the 2 syndications that we have coming up, both on the linker and the nominal side, over the next couple of weeks will focus investors' minds a little bit more about the weight of supply, and perhaps they will be, the first real tests of demand, I suppose. So what, we don't have, so can we just cut that bit? I'm just going to say, so yeah, watching out for those. And I suppose as we get closer to those dates, but it's in the end of April and the middle of May, we will discuss those supply events in more detail. But that's probably enough for now. There wasn't much on the UK side this week, so I will stop rambling and look forward to catching up with you both next week on all the things you've just mentioned that we have to look forward to. So thank you both for joining me, and thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.